Hello everyone out there, my name is Julius Nyanda with Homeowner Help Radio, where we help you get and keep your financial house in order. We're here today really talking about down payment assistance programs. This is one of my favorite topics in the world. I'm so passionate about helping first-time home buyers get into that first home. There's no better feeling. I love having them take pictures when you first get to the house. It's the best time to be a loan officer right now because prices are affordable, money's affordable. So it's a great time to be in the business. I've been in the business over 10 years, and I got to say that with all the chaos, and I feel bad for everybody losing their home, but affordability is there for people to get in and have a payment that they can actually afford to pay. With that said, I want to make sure that if you make under $100,000 a year, and this I'm speaking to both homeowners and real estate agents, if you have a client that makes less than $100,000 a year, please make yourself aware of the money that's available at the state, at the county, or at the city level. There's a lot of money still available. I know there's a lot of talk out there about cutting back and resources being cut back, but there's still a lot of money available. I want to make sure that I really stress that we're not going to go into all the programs tonight. I'm just talking about the MCC program, which is the Mortgage Credit Certificate, a program that's a federal tax credit, but it's administered at the county level. So we're just going to touch on the basics of that program. Even though it's a tax credit, I'm not giving tax advice, but I want you to just pay attention to the slides. If you have any questions, hit us up at helpradio1.com or email me at julius@helpradio1.com and I'll explain further. But listen to these slides. Let me know what you think. Always, please go to the site, hit the help button, or like my Facebook page, or tweet me back some information. Get at me. Let me know how I'm doing, or let me know about topics you want to know about. Check out these slides on first-time homebuyer program called MCC, or Mortgage Credit Certificate.
Welcome to the slide portion of today's presentation. This is episode 3 on the Mortgage Credit Certificate Program, or MCC. Now, this is part of the First Time Homebuyer series. Some of you will know from the previous episodes that we have a Deal Killer series. This one is to really point out the resources that are available for first-time homebuyers. So when we talk about down payment assistance, there's a few different categories. The first kind of down payment assistance is a subordinate lien or a community second mortgage. What this means is the second mortgage that goes behind your first, and it lowers the amount of money you need to borrow in the first, and usually it's deferred for 5 years with no payments, and some are deferred for 30 years with no payments. Some are deferred for 30 years and then you have to pay it off or sell your home. Some are deferred for 30 years and it's forgiven. It just depends on the type of program that you want to go into, but these are great programs to help people that can't necessarily buy a house that's $300,000 or $400,000, but they can help you get there with down payment assistance. Matching funds grants. These are programs where you put in $1, they match you with $2, $3, or $4, or $5, sometimes even $6 to your $1. Usually you're entering into this program for 12 to 18 months, and it's part of an entire nonprofit run program. A few banks facilitate it. These are great programs. I've helped some borrowers with this before. Voucher programs. Voucher programs for people that are in the system right now, maybe even a Section 8 renter, and you're trying to transition into being a homeowner. This is a great program for you. So these are ways for people that are renting right now to transition into being homeowners. What we're going to focus on today is the tax credit category. We're going to focus on that because that's what the MCC program falls under. When we talk about first-time homebuyer tax credits in general, you guys are probably thinking about the federal tax credit. That was the $8,000 tax credit they had over the last 24 months. It was a refundable program, which means not only does it allow you to lower the taxes that you're liable for, but it allows you to also increase your tax refund. So if you owe $5,000 in federal taxes, this $8,000 tax credit would pay off that $5,000 for you so you don't owe it, and give you a check for $3,000 as an additional refund. So it's a great program for people out there. California did have a similar program. It was non-refundable and spread out over 3 years, so it was a little less sexy than the federal program. So when you took the $10,000, it was really like $3,333.33 over that 3 years, and it was non-refundable, which means you can only get out or get back from the state what you paid in throughout the year. So there was no additional refund that was coming to you. Both of these programs shared one thing in common. They were both temporary. One thing I love about the MCC program is that it's recurring, which means as long as you own that home that you purchased as a first-time home buyer, even after you refinance, you can keep using the MCC credit. Now, when you refinance, you're going to have to get something called an RMCC, which they reissue the MCC credit to you. But it's a great program that you have for as long as you own that house. I mean, you can't beat it. So let's use an example. We got a homeowner out there, buys a home for $400,000, puts down 5% or 20 grand, $380,000 mortgage, 5% interest rate, basically $19,000 in annual interest. Pretty simple. What the mortgage credit certificate does is it takes 15% of that mortgage interest and it gives it to you in the form of a tax credit. So $19,000 times 15% is $2,850 that you get every year for as long as you own that home. I mean, can you imagine $2,850 a year? After a while, that starts to add up quickly. So it's a great program. I mean, I can't say enough about this program. Other MCC options, or better said, other MCC uses, are they can be used as additional income to qualify for more loan. That's a big usage. Some people are right on the cusp and they need another 100 or 200 bucks to be able to qualify. Hey, this is a great option for you. It allows you to go into your employer and increase your allowances that are on your W-4 form. Now, as a W-2 employee, when you first sign up for any employment, and some of you are just starting to get back to work, when you fill out that W-4 form, that W-4 form really determines what kind of taxes your employer is going to take out of your paycheck every month you get paid. So what we allow people to do as a lender is that $2,850 that we discussed on the previous slide can be taken as $237.50 as additional income, since we always look at you as monthly income. So $237.50, that can be a great thing to help you qualify for $20,000 more in loan amount, or it can help you offset debt payments. Debt payments are a big killer for a lot of homeowners. Some of you bought a car right before you want to try to buy a house. Kind of ironic, but it gets you in trouble. Other people have more, dignified actual claims. Like, let's say you want to go and buy a house and you want to borrow from your 401k. Well, that hit that you borrowed, whatever your payments are on that 401k loan, we have to count in your debts. And sometimes that disqualifies somebody, or they can't borrow as much. Well, the MCC can help you, solve that problem by using that money that it gets you, that $237.50, to offset some of that debt. Parting notes. I want to leave you some parting notes so we don't get any confusion out there. I am not a tax professional. I implore all of you to get with your tax professional. If you don't have one, get one. Some of you have been filing like a 1040 easy form, or you didn't really think taxes were a big deal before. Well, when you buy a house, you have so many tax deductions that are coming at you, and all the laws are changing as far as what you can and can't write off. You want to make sure you have a good relationship with a tax professional so you don't find yourself in an auditable situation or, getting in trouble with the IRS. MCC is a federal tax credit program, but it's administered by the county. So the county's the one that takes in the application, makes sure you qualify, but in the end, it's a federal tax credit. Beware of recapture tax if you sell in less than 9 years. So these are programs, anytime you get down payment assistance, it's really meant for the person that's going to be in that neighborhood or own that home for at least 10 years. Some of you that are out there, they're like, oh, I want to buy the house and move in 5 years. I don't know why, because the market is going to be pretty, crappy over the next 3 to 4 years. You want to make sure that you hold it for long term, because it's going to be beautiful probably in a 10-year span. So home ownership right now, I think, is more for the long-term home buyer, homeowner. You don't want to get in and try to flip. Those days are gone. But if you want to own this house and you try to sell it in less than 9 years, some of us have life circumstances that happen. You just have to be aware of the recapture tax. This, again, is a question for your tax professional, but basically a portion of that tax credit that's been given to you can be owed back if you move early. If you have any more questions or you want information about this program, you can hit us up at helpradio1.com. Hit that help button, let us know your question or thoughts, or you can email me directly at julius@helpradio1.com. Hope you enjoyed the slides.
Okay, well, I hope you got some great information in those slides. We just touched on it a little bit. We didn't want to go too deep. One of the things I want to stress is that we will be covering various down payment assistance programs over the next few weeks. So you may not have got all the information tonight. This is just one program, and the tax credit program happens to be my most favorite programs, only because it's broad in who it's offered to. There's a very high income threshold. So like I said, people that make below $100,000, in some cases $120,000, definitely want to ask your realtor, definitely want to ask your loan officer about this particular program. Check us out, Julius at helpradio1.com. Go to the website, helpradio1.com, Twitter, helpradio1, Facebook, helpradio1. Become a fan. Please show your support. Let us know what you want to hear about. There's a lot of